Welcome to Market Domination. I'm Jared Blikre, live from our New York headquarters. There's just an hour to go until the closing bell, and stocks are pulling back from all those record highs we got Thursday. And let's check out some of that red there. We'll go to the Wi-Fi Interactive, checking out the Dow first. It is down 204 points. And if we check out the intraday chart, we started in green territory. Then we had a little hiccup with Oracle, some bad announcements that sent the entire market south. We'll talk about that. You can see for the week, we are still looking at gains of about 1%. But the NASDAQ not only down 1.5% today, that's about how much it is down for the week. So giving up what was about break-even territory yesterday. And the S&P 500, well, we're down about 0.5%. And I'd be remiss if we didn't hit the Russell 2000 because that was hitting record highs yesterday along with the Dow. That is up 1.5% over these last 5 days. And I'm also going to check in on the bond market for you because we've seen a lot of movement here. This is, again, a 5-day look. We had a big drop after the FOMC announcement, but we are right back up to above where we started, and that is a 5 basis point gain for the 10-year to 4.19%. The 30-year now at the highest level in 3 months. That's up 7 basis points to 4.86%. And the U.S. dollar index, well, that is down for the week, and for today, just a little bit green. Now let's check in on the sector action because we are seeing staples, consumer discretionary. We're not even going to call that a gain for the materials, although it's up a basis point there. So really limited gains. Staples is a defensive trade. And what is not working today? That would be tech. XLK down 2.7%. And after that is energy. Those two rounding out the two underperformers. And you can really see some of the red here if we pull up the NASDAQ 100. And here's Broadcom front and center. That is down 11.8% after earnings. You bet we're going to talk about that. So the chip space, which I'm going to show you right now, that is not looking so good. And in software, not a whole lot better, but at least we're seeing a little green there. But stocks pulling back from records today as the rotation out of tech continues. Broadcom, as I said, one of the biggest drags on the NASDAQ after failing to meet sky-high expectations. And joining me now, Thomas Martin. He is the Global Investment Senior Portfolio Manager. Thank you for joining us here today. Let's start with some of the news of the day that's really holding tech down, and then we can get into some of the broader trends. But what are you making of the latest weakness that we're seeing here today?
Sure. Well, thanks for having me on your program, Jared. So, I think you're getting that December is always sort of a crazy month. The end of the year may be arbitrary, but, people want to end the year right and they want to begin next year right. And we have a lot of news that is creating, a fair amount of uncertainty, what with the Fed and just the whole AI concept and the parts that go into it and the market trying to get on the second derivative of what's happening there. So there's a lot going on, and you've seen the volatility come out in the market.
Yes, and Thomas, before we move on here, I just want to highlight, it seems the entire market is hinged on what happens with Oracle, and the headline earlier today that they were going to potentially delay one of their data centers for OpenAI. I'm not even asking you to comment on Oracle stock, just the fact that the entire market is so pivotally focused on this one news item today. Do you think that's a bad thing or a good thing heading into the end of the year, or is it just end of year stuff?
Well, I think it is, it's sort of all of the above, but also, AI and data centers and energy and electricity and chips and LLMs and productivity, all of that has really been thrown into this world of trying to figure out what's going to happen. I think that most people, if I could speak for most people, certainly we think that this is at the beginning stages of something that is going to take a long time, a decade or more, to really sort of home in on things. Even though ChatGPT moment was, a couple of years ago, and the market is trying to digest that. So the software itself, there keeps on being leaps and bounds. And first it's, ChatGPT, and then it's Gemini, and then it's DeepSeek, and then, et cetera, back to OpenAI. So that technology is leapfrogging and changing all the time. And then the idea of these physical data centers that, that orders have to be made. So for some of the bottlenecks that are, 5 years or more to get these critical pieces of equipment and the permitting, et cetera. So there's a lot of things that people can watch in the meantime, but it seems that it's hard for the market to step back and just say, let's get the positioning we want.
Yeah, it looks like, Thomas, we might have lost you there. So we're going to come back to you, and we're actually going to go to our next topic here. The S&P has not only seen new highs and records in 2025, it also made some new additions to its ranks, 3 of which were the market's biggest losers in 2022. And Yahoo Finance's Ines Ferre joins us now with a closer look. Ines.
Jared, yeah, and we're talking about 3 of the companies that weathered the 2022 bear market when interest rates were rising, when crypto was falling, when the S&P 500 that year was down 19%. And these 3 companies this year have been added to the S&P 500, or the third one, I should say, Carvana, will be added later this month. But look, if you take a look at these 3 companies, Coinbase, Robinhood, Carvana, let's start with Carvana because there are few turnaround stories in the market that really are as dramatic as Carvana. This company's stock was at the lows, was below $4 per share in late 2022. You had short sellers that were piling onto this stock, and they had done a dramatic turnaround over the last couple of years. In fact, the stock is now up 11,000% from that low that I just mentioned. And their CEO last year, when they turned a profit, really sort of summed it up, saying that most companies under the pressure that they were under would disintegrate. And they did not disintegrate. And now they are going to be going into the S&P 500. The other company that really has had a dramatic turnaround is also Robinhood. Robinhood right now, by the way, is on pace to be the 4th best performer of the S&P 500. You'll recall that this stock was down at around $7 a share at the lows in late 2022. They did cost cutting. They had layoffs. One analyst told me they really grew along the way because, of course, Robinhood came to prominence during the 2021 meme frenzy. And that stock has soared about 1,400% since that low that I just mentioned. And then you've got Coinbase, which Coinbase also went through the crypto winter. Coinbase was in the crosshairs of the SEC during the last administration. This year has been important for Coinbase because you have now an administration that is more crypto friendly. You have had the Genius Act in Congress that has been bullish also for Coinbase as well. And this company also is doing something similar to what Robinhood's doing with rolling out. It's going to be rolling out its prediction markets, its tokenized assets. It's in the retail space, but also, as one strategist or analyst pointed out to me, it's also, though, more in the institutional space as well and in the infrastructure. It's called the AWS of blockchain among analysts. So yes, there's convergence between Robinhood and Coinbase, but there is a difference there. And all these 3 companies that really were hit back in 2022 are now in the S&P 500. How fortunes have turned, Jared.
How fortunes have turned. Yeah, some of these stocks were counted out and almost permanently, but amazing to see some of the returns that we've gotten since then. Thank you, Ines. And I hear that we have Thomas Martin back with us. Thomas, sorry we lost you before, not sure what happened, but let's just jump straight into the Fed. We had a big Fed decision this week. The FOMC cut rates by 25 basis points as expected, but odds for rate cuts next year, I think 1 or 2 maybe are baked in by the end of the year, and that's changing on a day-to-day basis. Got a bunch of Fed speak this morning. What are you focused on here?
Well, the Fed has a lot to deal with their dual mandate. And I think that, what this meeting exemplified was that both the inflation side and the employment side are difficult to handicap. And different of the governors and board members have different priorities for how they analyze that and think about it. And that's where you're getting the divergence of opinion. And in the meantime, the economy is doing fairly well. Yes, employment is weakening, but it's still okay. And inflation is really not doing much of anything. So they're in a tough spot. They took out another insurance cut. And then I think the markets are wrestling with, well, is that good because it will kind of cement that the economy will stay good? Or is it not so good because it really could start to incite inflation?
Well, before we go, I want to get your stock picks because some of these are pretty interesting. We were just talking about Carvana, and I think that's on your list, but lay them out for us. What do you like right now?
Well, just for Carvana, I certainly agree with that. And what's driven the price up is just all the work that they've done on their business, their balance sheet, their operations, being able to source cars, being able to have a reliable product to deliver to their customers, to get their pricing, et cetera. And the fact that they have less than 1 million units that they're doing in a market that is 37 million units, and potentially the online market for used cars is growing at in excess of 25%. So that one's terrific. One that I don't think you mentioned was Seagate Technology. Mm-hmm. And on a day like today, it's not doing so well when the AI trade is off. But as I said earlier, this is something that is going to continue for a while, and memory is going to be a big part of it. And there are shortages in memory. So all sorts of things. They have a technological advantage with their Hammer technology, about a 2-year lead over the other folks. They're going to be able to not only grow their revenues, but also grow their margins over time. So that one we think has got a good ways to go. And the last one is Live Nation, which is not an AI stock, but is for the eyeball people and the public imagination and the experience economy. And Live Nation has a worldwide reach where they have the artists, they have the ticketing, they have the venues, and they have sponsorships. And it all tends to drive each other, that in the social media age, and they're able to capture those eyeballs and deliver them to their customers.
All right. Yeah, really appreciate you sticking with us here, and thank you for those insights, Thomas.
Great, thanks so much.
And coming up, Rivian unveiling a custom self-driving chip as it makes a push into AI. We're going to hear from the CEO next on Market Domination. Now time for some of today's trending tickers, starting with Oracle. The company denying earlier reports that it was pushing back data center projects for OpenAI to 2028. Oracle reportedly telling Reuters that all milestones remain on track and there have been no delays to any sites. Oracle has been working on a $300 billion contract to supply computing power necessary to train and run OpenAI's models. And turning to the IPO market, Wealthfront makes its public debut on the NASDAQ, trading under the ticker symbol WLTH. The financial services company raised about $485 million in an initial public offering, and the stock opened at $14 a share. The company is known for its automated investing products and an online platform that's attracted younger customers. And lastly, Costco posting better than expected earnings in the first quarter, while total revenue roughly met Wall Street expectations. And comparable sales climbed 6.4%, topping analyst estimates. But membership fees seeing a slight decrease compared to the previous quarter. The company pointed out lumpiness in the individual monthly sales results when looking at it month by month, but highlighting a lot of it being tied to uncertainty around tariffs or port strikes that they have tied to this cycle. And another top trending ticker is Rivian. Shares of the EV maker rebounding from Thursday's slide after a slew of announcements focused on autonomous driving and chips. Senior reporter Pras Subramanian here is more. And Pras, you just sat down with Rivian CEO, and we got this huge pop today. I don't know if there's a correlation.
Yeah, some Wall Street commentary, bullish, maybe me, of course, but also some bullish Wall Street commentary. But yeah, Rivian's Autonomy and AI Day was a big deal. The company outlined its self-driving strategy, an iterative process that will start out with the universal hands-free, similar to GM Super Cruise, that will work across 3.5 million miles in the US, and then evolve into an eyes-free and hands-free self-driving product that will, the eventual goal being personal level 4, meaning it will drive you around like a robotaxi, even perform some errands like picking up your kids. I spoke to CEO RJ Scaringe, like you mentioned, Jared, about this from the event, and we kicked it off talking about why custom silicon, meaning in-house designed chips, are sort of the way to go and why it made sense for their AI-centric approach.
We made the decision years and years ago to build our entire vertical software platform in-house, all of our computers in-house, and not rely on tier 1 suppliers for any of that content. It wasn't like we said we're going to go do that and then didn't put the work in. We then built teams of thousands of people to go put all that together. Spent many hundreds of millions of dollars to develop those systems. And when we've approached autonomy and our overall AI roadmap, we had a very similar view, which is this is going to be the most important technical shift in transportation. I would say more than anything else, more than anything since the beginning of the car. And we wanted to control our own destiny. So back in 2022, when we began this process of redesigning and clean sheeting our platform, we said to do that, we want to control the perception platform. We want to build a very robust data flywheel. We want to build this around extremely high levels of inference, so very, very smart brain. And we need to make this fit into a package that is cost effective. And so to do that, one of the big drivers of cost is the inference, is the compute. And so we ultimately decided to bring that in-house. And then again, that's like, if you do that, that means you're signing up to spend just on the chip alone many hundreds of millions of dollars. You need a very large team to do it. You need to recruit a team that's incredibly capable of developing silicon. You need a partnership with TSMC or equivalent, but most likely TSMC, which in our case is our partner. And what we're going to get is better performance. It's something that's very specific to vision-based robotics. The instance here is a vehicle. You can imagine there's other instances in our business that might benefit from a inference platform for vision-based robotics. And then we needed to build this data flywheel. And so lots of offline training, that means lots of GPUs. But this is by far our biggest investment category as a company from an R&D point of view.
I heard, we hear a lot about the data center plays and people that are investing heavily in chips, and how making your own chips kind of cuts your margins in half, right? Mm-hmm. That's so powerful it could be once the investment's made. So, I want to mention Tesla because they sort of are doing the same thing with regards to going fully vertical. They have their own chips, they're doing their own data centers. Do you think that, and your autonomy plays different with different sensors suite, do you think that you guys can sort of meet and surpass where they are now in the next couple of years?
I mean, of course, our goal is to be world-class. Tesla, to be clear, is a great product. They built a really impressive platform. We very much are aligned with them on believing it needs to be a neural net-based approach. Building an end-to-end trained model that's using the fleet of vehicles, building a data flywheel that trains the model with reinforcement learning. So we really agree there. We do have a different view on the benefits of a diverse set of perception modalities. In our case, being still camera heavy, call it camera primary, but by including radar and LiDAR, it allows us to turn our entire fleet into a ground truth fleet. So every vehicle on the road is very helpful in training our model. So we have the view that it'll allow us to build the model very rapidly, and then those sensors, in addition to helping us build the model, really do a nice job of covering some pretty extreme corner cases. So of course, radars have the benefit of not being affected by low visibility conditions. So things like fog or rain, it does very, very well in. And LiDAR has the advantage of being able to really accurately perceive the three-dimensional world, and it can be used to train a two-dimensional image of a camera. So you can really use it to accelerate the speed at which the neural net can understand the world. And so that's been our approach, but our view is getting to level 4. So this is, I think that's the end state everyone needs to be thinking about. And this is no longer science fiction of 10 years from now, 15 years from now. This is like in the fairly short horizon, next few years, we believe personally owned vehicles should be offering level 4. and it's going to change the way you think about your car. Your car suddenly, your car almost becomes like does some of the things if you were to have a nanny. Like you could have your car go pick up the kids from school. I have 3 kids, and they're 9, 8, 7, so they're in sports, many different sports, constant practices and drop-offs. It's like pure chaos trying to get everybody to the right place. And so I know in my own life it'd be very helpful to have a car that would be able to move them around to the different places and different practices and events that they're going to.
You know, we hear 2026 maybe an inflection point there, so we'll have eyes on that. I know your time is limited, but I just want to ask you about the bigger picture of the EV industry in America. You know, the tax rate went away in the start of Q4. How are things going for you? I know we can't talk about, you know, metrics, but how does the market look for you right now? And I've heard people talk about how the pure play EV makers might actually benefit from this because they have fewer competitors in the market. Yeah. I've heard that. And I'm not sure if that's true or not, but what's your sort of overall take on what's happening here in the US?
I think in the long term, it doesn't materially change, the end state. I do think the dynamic, like the system dynamics and like the causality of what others are going to do is interesting to think about. It's, I think what you postulated in your question is probably somewhat right. I think you are seeing a lot of manufacturers pull back. I think that's unfortunate. I think it'd be healthier for the auto industry if everybody was focused on electrification. I think that pullback means there's going to be less choice, which is bad for customers. But I do think because there's less choice, it means it's going to be a less competitive environment. And so we can't control what others do. We can control our own business. And so the things we can do to help drive electrification adoption are make incredible products and give customers additional choices. You know, if you were to look at the segment of vehicles with price points that start under $50,000, there's very few highly compelling choices. And as a result of that, a single company, Tesla, has accumulated around 50% market share. It moves around, quarter to quarter, but call it half the market under $50,000 is one company. And that's not a reflection of a healthy industry. It's a reflection of an underserved market. And so if we want to see electrification go from its 8% of adoption, which is what it is in the United States today, to let's say 25 or 30 or ultimately 100%, we need to have more than one great choice. And I think Tesla will continue to be a great choice, but I think there needs to be others. And of course, I think Rivian is one of those with our R2. I think it's going to be exceptional. The car itself is just amazing. But I hope there's others. And we're excited to have a partnership with Volkswagen where we're helping to take some of our tech, applying it in their vehicles. I know the vehicles we're doing in partnership with them are also going to be great vehicles. So there's going to be some choices there. But I think the market's underserved with choice today.
So yeah, the Rivian R2, which is their mid-sized vehicle, is going to be a big deal when it comes out next year and then sort of ramps up throughout the year because as RJ mentioned, Tesla commands half the market with EVs and under $50,000, and they really need that to even that and really make a difference from a mainstream point of view with EVs.
And making your own chips is no joke, and we're going to leave it there because of time, but thank you for stopping by here, Pras. Great interview. And coming up, the outlook for the bond market heading into 2026. That is next on Market Domination. We're getting the first commentary from members of the FOMC after the Fed cut rates earlier this week. Fed correspondent Jennifer Schonberger is here with more. Jennifer.
Hey there, Jared. That's right. We are hearing from some of the hawks who dissented this week. Chicago Fed President Austin Goolsbee and Kansas City Fed President Jeff Schmidt both laid out their cases this morning as to why they preferred not to cut rates this week. Goolsbee said he wanted to wait for more data on inflation before lowering rates further, though he added that he remains, quote, optimistic that rates could come down by a, quote, significant amount over the next year. Goolsbee saying that, again, he is uneasy about too heavily front-loading rate cuts and just assuming that inflation will be transitory. He said waiting to take this matter up in the new year would not have entailed more additional risk. Given the last several years, getting more evidence first feels like the wiser choice. Meanwhile, Kansas City Fed President Schmid, who dissented for the second policy meeting in a row, said his outlook has not changed and that he believes inflation remains too high as the economy shows momentum and the job market, though cooling, remains in balance. Schmid saying that, quote, right now I see an economy that is showing momentum and inflation that is too hot, suggesting that policy is not overly restrictive. Now, elsewhere, one of the soft dissents, if you will, Cleveland Fed President Beth Hammack, who will be a voting member next year and who, coming into this week's meeting, said she was not in favor of lowering rates, said today that she thinks rates are currently around neutral now. In fact, she said she would prefer that monetary policy be, quote, slightly more restrictive than current levels, as she believes inflation remains stuck above a full percentage point above the Fed's 2% target. Now, elsewhere on the flip side, we also heard from Philadelphia Fed President Anna Paulson, who will be a voting member next year. She's actually more concerned about the job side of the dual mandate than inflation. She believes that tariffs will peak next year and housing inflation will come down, all of those factors working together to bring down overall inflation over the course of next year. Jared.
Thank you, Jennifer. And we saw fallout from the Fed's rate cut in the bond market this week, and now yields are bouncing back. Joining me now is Vishal Khanduja, Morgan Stanley Senior Fixed Income Portfolio Manager. Great to see you here. Let's stick with the Fed first, and then we'll get more into the wonky bond stuff. But what do you think about the latest cut that we saw from the FOMC, the forward guidance, and then just kind of laying out what we might expect from the Fed in 2026?
Perfect. Hey, Jared, good afternoon. Thanks for having me on.
You bet.
The Fed delivered slightly different than what the market was prepared for. I think the market was prepared for a very hawkish cut, meaning cut, but then completely pushing back on 2026 expectations of any more cuts. I think in return, what they got was a Fed which was very balanced, still focused on the downside in the labor market, but then still very upbeat about GDP into 2026. So up their expectations of GDP going into 26, their inflation target was slightly lower for 2026, and then still remaining dovish on the labor market side. So still leaving that two cuts there for 2026. And then we know, Jared, that the makeup of the Fed is also drastically shifting. I think the next four meetings are going to be the last of Chairman Powell in there, and the makeup could be a lot more dovish. So, the market is taking it very positively post the meeting.
All right, let's back up a second and just kind of take stock at what's happened in 2025, because we had a new president. This was President Trump's second time in office. Arguably, the first time was he was really focused on the stock market, but I think he was really focused on the bond market more so this year. And if we can go to the Wi-Fi Interactive, I'm just going to show you real quick a 30-year T-bond yield chart. This is year to date. And one of the things that happened was when long rates were creeping up above 5%, and I'm circling them here, stocks kind of rolled over. They had a tough time with that. And it's just something that stuck out with me. So I'm just wondering, are there any key levels in bonds that you're looking for, or is it the speed of the move? Kind of what should we expect here that might spill over into other risk markets?
Jared, a repeat of 2025. I think the bond market, especially the long end, 20 and 30-year bond prices and levels, will be extremely key for the administration to watch out for. So we look at the difference between the 5-year and the 30-year, which is a clear indication of the steepness, which then is defined and directly looking into what the Fed is doing, as well as what the deficit situation here in the US is, which is deteriorating and doesn't expect to get solved in a midterm year like 2026. So that, 530s curve was negative 100 beginning of last year. It went up to positive 125 sometime this year, probably about 8 weeks back, and is back up to that 110. We do think that, that level could creep up, the 5s to 30s yield level could creep up to 150 basis points in 2026, which will be direct a deficit situation issue that the market will bring it to the front and center.
All right, now translate that pain scenario for the bond market into what we should be watching out for. Like, how does an average investor play this, or what should they be watching out for in terms of the headlines here in the new year?
Quite a bit of markers, but if I can back up, 26 for us as an outlook for fixed income is going to be a repeat of 2025, where fixed income allocations for clients and investors deliver on that dual mandate of fixed income. So the first mandate of fixed income is income and total return, which each and every high quality as well as low quality part of the fixed income market delivered on it very efficiently this year. And then the second part of the mandate, or the second mandate out there for fixed income, is negative correlation to risky assets during times of economic volatility. Exactly what the fixed income market did in 2025. So we see a very clear repeat in 2026, where the starting yields, which are the very clear high efficacy indicator of total returns, are still around that 7 to 9%, depending on the part of the fixed income market you're looking at. That is what we think what 2026 will bring in. And then the 0 to 10 year part, again, if you can avoid that 20 and 30 year part of the fixed income market, that delivers on that negative correlation to risky assets. So we do think that it's poised extremely well with, economy doing well, balance sheets doing well. And then the Fed doesn't have to cut that much for that dual mandate to be delivered for fixed income in 26.
Yeah, a different dual mandate, I should stress there. Let's talk about the corporate market in particular. I've read a lot over the last few months, some concerns. We had some credit events in corporate credit, some defaults. JP Morgan's Jamie Dimon has commented on them, called them cockroaches. I'm wondering how big that problem you think it is coming into 2026, and are there any pockets? I've heard private equity and kind of the fringier parts of the markets there.
Great question. Yes is the very clear answer. Dispersion is just about starting in credit market. So yes, idiosyncratic from what happened in a couple of those bankruptcies that were announced and the events that led to it, but not idiosyncratic from the part that certain parts of the economy are struggling. We go back to the K-shaped economy, the upper part of the K-shape, the consumer, some of the banks, some of the tech-related spending that is happening is doing extremely well. That's why nominal GDP in the U.S. is doing extremely well at this point. But the bottom end of the K-shape, the subprime consumer, certain parts of the real estate market, certain parts of the cyclical economy that has not participated in this investment boom that has gone through in the last 18 months, is going to start showing up some different credit outcomes in 2026. So in our minds, if I wanted to put it in one statement, it's avoiding the wrong bond is going to be extremely important in 26, rather than picking up all the great bonds that you could in 2020 and 2021 when valuations were extremely lucrative and wide at that point. So active management, pick your right spots. Security selection is going to be extremely important as credit dispersion is just about starting to increase.
All right, well, bond picking sounds a lot more difficult than stock picking, but I really appreciate your candor here and lots of insights, Vishal.
Thank you very much.
Coming up, the top retail trading trends right now, where individual investors are finding opportunities, next on Market Domination. 2025 is turning into another record year for options trading. And for those looking to add some proven strategies to their toolkit, we're breaking down some basics in this options playbook sponsored by Tasty Trade. And after another year of big market gains, many investors wouldn't mind generating some income from their stock holdings without having to sell the stocks or ETFs they're invested in. And a simple way to do that is with what's called a covered call. It's basically an option strategy where you sell a call option while also owning the underlying stock. You're saying, I own the shares and I'm willing to sell them at a certain price by a certain date if I'm paid up front. And since we're selling or writing the option, we collect what's called a premium, which is like an insurance payment from the option buyer. That's cash in your account today. Now, if we did not own the underlying shares and wrote an option, we could be exposed to unlimited risk if the stock price went straight up. And since we own the shares now, if the stock price settles above our strike price on expiration date, we just have to give up those shares, taking a cash payment for them in our account. So your upside is capped when the stock goes up, and you might lose your shares, but you also pocket that premium, which effectively reduces the price you paid or your cost basis for those shares. Now let's use Tesla as an example, and I'll set this up on the Wi-Fi interactive here. I'm going to show a 2-year chart. And if you're noticing here, this is a cup and handle formation. It's in technical analysis, and it's tracing out with a top of about $480. I think the absolute price ceiling was $489 back in late 2024, but we'll just say $480. And the next big expiration date after December is in January. The third Friday is always January 16th. And I'm going to bet that Tesla does not shoot above 480 and hold there into that date. And it very well could shoot up there, but I'm going to bet by January 16th that Tesla will be below 480. So now for the trade details, which is just an example and not a recommendation by any means. We're going to assume that we just bought 100 shares of Tesla at the somewhat current price of $445, and we're selling the 480 strike price with an expiration of Friday, January 16th, in about a month. We're collecting a premium of $16.43 per share, or $1,643 total. That goes in your brokerage account, and if you subtract it from the shares you bought at $445, that means on paper you now own them from about $428. Finally, the max profit on this trade is $5,143 if Tesla rallies to $480 or above by expiration. And that includes the share price appreciation on those 100 shares. And as I said before, if Tesla is above 480 at the end of expiration day, those shares will be taken out of your brokerage account and you'll be paid $48,000 for them. All in all, it's a roughly 12% return in 5 weeks on the amount at risk in this example, and that's before any fees or taxes. Now let's show how the profit or loss on this trade can vary with the Tesla stock price. Now here, the vertical axis is tracking your profit or loss, and the horizontal axis is the Tesla share price on expiration on January 16th. The solid vertical line in the left middle, that is the $445 purchase price, and the dotted line is your break-even price at about $428. That's $445 minus the 16 and change that you got paid for that premium. So if Tesla stock sinks below $428 on expiration, you've lost money on the trade, with your losses getting bigger the more Tesla stock drops. But if Tesla settles higher than $428, you have made money. And notice that the profit line starts going sideways right at the $480 mark. You don't get any more profit upside above that level. Bottom line, there's no free lunch and options aren't for everyone. But if you take the time to understand the risks and the math, strategies like this can become part of a more deliberate plan rather than just another hot trade. And for more on the shift in options activity and what retail traders have been up to, we invite now Moomoo CEO Neil McDonald. He's joining us here with a closer look. And Neil, great to have you here. Thank you for joining us.
Thank you, Jared. Happy Friday.
Yes, happy Friday.
Almost year end. Almost year end.
But critically, we've got a few things to talk about. We had some major events happen this week, and that doesn't always happen in the middle of December. We had that big Fed announcement, but more importantly, I think we got some big earnings. Broadcom is down huge on this Friday. What are you seeing in the Moomoo book here?
Sure. I mean, what's amazing with Broadcom was the headline figures look great.
Yeah.
They look great. And then we have an AI bot, and if you ask the question, it finds that in his statements and his press conference, he had uncertainty and mentioned some fairly negative statements that kind of changes the narrative. So what we've seen is retail buyers, as you know, they've been holding this market up all year. So back in April, Liberation Day, we at Moomoo had the largest single day influx of cash into our system.
Wow.
And they bought the dip. Today we've seen money come in this afternoon. We know that's being put to work. I think the retail investor, he's not a hedge fund manager. He's not going to get sacked by his partner for having a bad quarter, right? He's investing, or he or she, investing much more for the long term.
Yeah, they're trading their own money.
They're trading their own money. They're not mark to market. They're not looking at monthly returns. We've seen it in NVIDIA, our most popular stock still. We have clients, January 23, paid $18, and all they've done is buy every single dip on the way up. They haven't always added as the price has gone up, but every pullback they've seen as an opportunity to dollar cost average in at a better price.
I find this discussion of the changing retail trader absolutely fascinating. And one of the things that I think you're hitting on that you have in common with a lot of other broker execs is that the retail trader is getting more sophisticated in strategies in terms of thinking about their trades. And we've come a long way from 2021 where people are just, dishing out stimmies and putting in their account and then, zero DTEs, see it kind of go up in smoke. Tell us about the evolving retail trader here.
I think if you look at your example then showing the payoff in the Yahoo graph, right? Those kind of analytics, those kind of tools, both on the Moomoo platform and others, you get much better visualizations now, and especially with AI tools as well within the platforms. You get a much better idea of your risk return and your horizon. We have on our platform, we have an option strategy builder. You put in your view on the stock, how bullish, how bearish, your time horizon, your risk profile, and it will build you a strategy, and then you can click and then trade that strategy. So these kind of tools, a bit like you showed on Yahoo with the payoff graph, they're just becoming much more common. People are becoming much more sophisticated.
Yeah, that's a great thing. Talk to us about some of the other trends you might have seen with volatility. We saw some volatility scares over the last couple months. They weren't huge, nothing that compared to April 8th, but that in itself was maybe a huge overreaction, at least in terms of the VIX reaction I was looking. How do retail traders process and trade volatility now?
You know what? They're better traders than me.
Wow.
So I can tell you that much. Their fortitude, and they tend to not trade the noise as much as I'm a fairly emotional trader, even though I've been doing it for 38 years. I fight my natural instinct every day to FOMO in and panic out. I'm a human being. But we have this big community of 28 million people, and we have 6 million daily interactions.